Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. He tells us while some markets have again hit record highs, there are signals we are heading into stagflation. Gold has hit new highs. Ross checks out gold, silver, crude, and the US and Canadian dollars. Longtime trader Victor Adair joins us from Vancouver Island. He gives us his take on where interest rates are headed. He comments on inflation, the US and Canadian dollars, bonds, copper, and crude. Victor tells us what has stayed the same despite all the technical changes in trading over the last 50 years. Author of the second edition of When the Bubble Burst Surviving the Canadian Real Estate Crash, Hilliard MacBeth, believes we are seeing that bubble slowly but surely blow up, especially in Canada's biggest cities. Hilliard gives us his take on the Canadian bull stock market, rising unemployment, gold and junior miners, tariffs, and Alberta independence. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Always a pleasure, Jim.
Did we see record highs again on the stock markets?
Yeah, we're seeing it, we've got record highs in the S&P and in the NASDAQ, and here we've got the, even things like the Russell 2000, the small caps, are new high for the move. They're still shy of the highs that we put in back in December, but still, it's part of this uptrend that we've got that's really nicely in motion. The correction that we had into the last day of August and into September the 2nd was right at the 20-day moving average on most of these indices, and it's a good spot to bounce from, in particular when you're looking for action around the turn of the month. And in this case, that low that we've now put in looks to be the key one that we want to keep an eye on. This week or next week, we've got the Fed meeting with the projected decline in the Fed funds rate coming out of that. Now, the T-bill rates have been dropping consistently for the last couple of months. The 6-month T-bill is now down to 3.86. While the Fed funds is stuck at a higher level here at 4.33. So you get about a 47-point differential, and the Fed funds will historically follow what's going on in the T-bills. So you'd expect to see a minimum 25-point move in the Fed funds rate and very possibly 50-point basis point move. Based upon what we're seeing in the T-bills. So, that's the market's priced in for that next week, and I would suspect that there's very little reaction to the stock market regarding that. There might be lots of press and lots of headlines, but the reality is that this is already priced in, and it shouldn't be so much as a political move that's pushing the rates down. It will be a catch-up in terms of what's happening in the open market, and that's what we always want to watch is more what's happening with the open market rather than the perceived political pressures that are on there.
What's going on with gold?
The gold market, new all-time highs this week. Silver is now following suit in a fairly similar fashion, but not quite as strong. Now, the interesting thing here in gold is if we take a look at this consolidation that we had from the April high into August, The pattern there, that pullback is very similar to the ones that we've seen historically on broader time ranges. If we take a look at the 2020 to 2024 correction that we had, we take a look at the 1980 to 2006 one, and the 1975 to 1978. When we measure the depths of those corrections and then do some upside projections, we ended up with good numbers on the upside. 2.618 measurements were the minimum on the upside. Those are Fibonacci targets. And this time around, we've got some good targets that we published here this week, and looks as though there's still lots of running room as far as gold is concerned. Silver doing a catch-up right now, and typically on the latter part of the move, silver will outpace the gold market, so we should be looking for that as this thing progresses along. Now, overall, the gold market, I would think that if we're going to have mild corrections on the move up, probably back to the 20-day exponential moving average. Major corrections would probably hold at the 20-week moving average. So both of those numbers at this point would mirror a retest of the breakout highs, but I don't think we're coming back that far. So these moving averages, though, as they move up with the price, should become key levels to keep an eye on.
What's going on with crude?
Crude is just biding its time with a slow downside bias. We're sitting at $62. And historically, about 3/4 of the years, you'll have a decline into October to December. And what we like to see here is on the weekly charts, in terms of identifying the low, we look at sequentials. So that will be 9 consecutive weeks where the price closes below 4 weeks earlier. And by the time you do that, in October to December, that can produce a pretty good price low. So at this point, there's lots of time to go on this thing. We're probably looking at the better part of a month and a half at the earliest before we could be looking for a bottom. So, that's ideally from this perspective going to be into the $50 range. Maybe the mid-50s. We'll see what it looks like as it's going down. But the best lows are created when you have a concerted or consistent move to the downside. So we'll be looking for completed counts as we get to the bottom of the move.
What's going on with the U.S. and Canadian dollars?
U.S. dollar is still coiling. You're not seeing anything significant at this point. We've got it now, bound by lows at around 97 and change, and top ends up at 99 plus. But at this point, trend, if anything, is to the downside for now. And when we look at the Canadian dollar, it has been trending. It had a good rally and has now been trending to the lower side. Now, and that's right part and parcel with the action we're seeing in the crude oil market. So if crude oil is going to continue down towards a seasonal low, the Canadian dollar will probably remain under pressure during that time period.
Ross, thank you so much for the update.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on X at Charts by Ross. Coming up, Victor Adair, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Victor Adair, recently retired from nearly 50 years of being in the brokerage business in British Columbia, but he's still very active in the markets. He's speaking to us from Parksville on beautiful Vancouver Island. His website, Adair.Ca. Welcome back to This Week in Money.
Well, Jim, it's always a pleasure to talk with you. Thank you for having me on.
Before we discuss individual markets, is there anything you think represents a broad consensus of market opinion, something that's affecting prices across all markets?
I do, actually, and I could be a smartass and say, people are in a mood to believe that, the stock market's just going to keep going up and we'll never have another down day. But there is something real, and that is, I think there is a very broad consensus across markets that the Fed is going to start, call it, an easing interest rate cycle next week. In other words, they're going to start cutting interest rates, and they're going to keep cutting interest rates for the next foreseeable future here. Let's say the next year or so. And that consensus is pretty strong. And one of the ways you can see how strong that is, I just look into the pricing for where the market thinks interest rates will be at different points in the future. And basically, the free markets, as we call them, are pricing. The Federal Reserve will have interest rates about 150 basis points lower than where they are right now by the end of next year. And that is going to happen over, let's say, starting this week ahead with a 25 basis point cut. And then before the end of this year, we'll probably be off 75 basis points, and then obviously another 75 points as we go through next year. Now, of course, the market can change its mind or change the pricing if something comes up, but that's where it's at right now. So if in fact that were to play out, then people in the currency market, people in the gold market, and so on, certainly the stock market, take that into account when they're deciding whether or not to be a buyer or a seller or whatever, right now. So, we can look at that when we talk about individual markets. But I think that is probably the standout consensus opinion right now. The Federal Reserve is going to be cutting interest rates. They are motivated because they want to focus on their employment mandate. In other words, they have a mandate to do the best they can to create full employment. And they've been worried about job losses, and they're going to focus on employment, and they are going to be less focused on trying to control inflation. I think you could also say, while I'm on a roll here, that the market appears to be accepting the view that the Fed is going to tolerate inflation running above its 2% target.
If the market consensus is that the Fed is less focused on controlling inflation and more worried about unemployment, what happens to bonds?
Yeah, well, that is one of several $64 million questions. But so far, I guess here in the last couple of weeks, bond yields have been falling. And I can see going ahead here, like the bond market sort of being torn between two broad views of the world. One is traditionally the bond market or bond yields will fall if the economy is slowing, and the economy would be slowing certainly if employment was going down and that sort of thing. That's kind of a traditional reaction. I think another reaction to the bond market is the Fed isn't going to be focused on inflation, and the bond market really worries about inflation. And it's just simple. I mean, if you buy a 30-year bond, you're waiting for 30 years to get your money back, okay? And in the meantime, you're going to get an interest stream based on the coupon. But if let's say your coupon is going to be 4% and inflation 2 years from now is 5%, you're going backwards. Now, you could sell your bond, but you're going to sell it to somebody that's going to discount that. So the bond market traditionally has a worry about inflation as well. So then we maybe bring up the dreaded S word, which is stagflation, where you have falling employment and rising prices or rising inflation at the same time, and that's just like the worst of all worlds for the bond market. I don't know. I'm not going to pretend I know what's happening. I'm predisposed to kind of side with the bond bears. In other words, I think governments locally, locally in North America, but around the world, really don't care anymore about paying back the money they borrowed. That you can say they're evil and that they're doing this on purpose. I just don't think they have the political wherewithal to do that. So I'm in the school that inflation will probably be higher. So if the Fed's going to be cutting interest rates because they're worried about employment and they're not going to be so worried about inflation, and particularly if in fact they're going to allow inflation to run above target. And let's have an interjection here. Who is they now? And that's important, given for the folks that are following the news, it appears as though they, the Fed, the composition of who they are or what their political views are is subject to change and likely will change. Certainly the Chairman Powell, his term is up May of next year, but there's a lot of maneuvering going on here, and I'm not going to go into chapter and verse about this kind of thing. But the people that make up the FOMC, the composition of that's going to change, and I think what we're going to be in going forward is an environment of not only fiscal stimulus, that's from the government spending, but also monetary stimulus. Trump seems to, it doesn't hide the fact that he would like to see, or he demands to see, the Fed get interest rates down to 1%. Well, that's pretty stimulative. And if, in fact, you have that kind of an environment, I think what happens, a number of things, but keep it short and sweet, I think the value of the currency goes down, or the purchasing power of the currency goes down, and to me that is the bedrock definition of higher inflation. So what happens to bonds, Jimmy? I'm not sure, but I'm inclined to bet that way. The other way is, if the economy slows down and let's say the stock market starts to wobble or something, people may think that there's relative safety in the bond market, so they go over there and the bonds stay bid for a while. But I'm kind of from Missouri on that story.
Gold prices are up approximately 40% this year. Gold share prices up even more. What are your thoughts about gold and gold shares?
Yeah, gold is the gold bullion roughly doubled in price from October of 2023, where the price was before Hamas attacked Israel. Let's just stay with gold. I have a lot of questions about gold. We are here at all-time highs, and that's all-time highs both in nominal terms but also in inflation-adjusted terms, and I think that's important. My good friend for the past 30-some years, Martin Muirfield, who was a real gold expert for a long time, would put up charts to say, gold prices are making new highs in nominal terms, but inflation-adjusted terms, not so much. But now that we're above, I think it was about $3,300, gold prices now in inflation-adjusted terms are higher than they ever were, like back in 1980 when the price very briefly reached $850 an ounce. And I was trading back in those days, and I tell you what, I watched that gold market more than double in value in just a couple of months in late 79, 1980. Certainly one of the keys then was the Russians had invaded Afghanistan. But I've seen the gold market parabolic before. Back in those days, I'd go down to the basement level of the Bank of Nova Scotia and see people lined up around the block to be buying bars, bricks, or wafers, whatever, coins made of gold. We certainly don't see that now, but, in the Internet era, maybe, we'll never see that. Anyhow, I think the gold market here, the last few years, we saw a disconnection between a long-term correlation between a negative correlation between the value of the dollar, interest rates, and gold. In other words, if the dollar was rising and interest rates were going up, that was like kryptonite for the gold market. But that broke down. And people were wondering what happened? Why did that? Well, why it happened, I believe, is that central banks, following particularly the Russian invasion of Ukraine, decided, and particularly central banks like China and Russia and that sort of thing, decided that they would rather have gold than take the risk of holding U.S. dollar assets that could be confiscated or whatever in the event of blah, blah, blah. So the central banks were interested in gold, and they wanted the gold in their own vaults. They didn't care about gold mining shares. They wanted bricks of gold, downstairs in the basement. So that was one of the reasons, I think, that the gold shares underperformed gold for quite some time. The main buyer of gold only wanted gold. They didn't want gold shares. Now, back in the day, let's say the commodity boom from 2008 to 2011, we had gold shares rocket higher relative to the gold price as buyers realized the leverage that you got from owning gold shares. The leverage was the price of gold's going up way faster than the cost of production of the gold mining companies, so you had this terrific run in the gold mining shares. Over the next few years, the gold mining shares kind of went in the doghouse. There was a lot of, let's say, the market's view anyway was that there was a lot of poor use of shareholder money by some of the gold mining companies. In other words, they started getting into things that maybe were poor acquisitions and that sort of thing. Lately, I think the rise in the gold shares relative to gold here, and I use the GDX. It's an ETF for gold shares. It's doubled so far this year, up 100%, while gold's up 40%. And I think what we're seeing now is people are really recognizing the leverage in the gold mining shares. And there may also be some folks out there, and I think this is real, that if you were working for, say, a pension fund, you might be prohibited from buying bars of gold. But you're certainly able to go and buy shares, particularly, say, a company like Newmont that's listed on the New York Stock Exchange. So if you were bullish on gold or worried about the dollar or whatever, driving you to want to have a position in gold, and you can't buy gold bars, you went out and bought shares of some of the leading gold mining companies. And when people come stampeding into a market for whatever reason, the price goes up. So we've seen a terrific rally here in the gold shares. Where do we go from here? I kind of think the market might be a bit ahead of itself. It's say it this way: if I bought gold today and I wasn't planning to sell it tomorrow, in other words, I'm not looking to make a fast $10 or something on gold, how much? If it fell, at what level do I think it would find support? And I think at today's price, if you're going to be a buyer for gold and you want to say, I need gold in my portfolio, I'm gonna buy this and hold it, I think you have to be prepared that the price could back off 10 or 20%. And I'm just pulling numbers out of the air here, but it's not going to back off just like $20. When markets go parabolic, whatever they are, whether it's tech stocks or marijuana stocks or gold, when markets go parabolic, they do not correct by just going sideways. So I think there's some risk in buying here, but the price is where it is.
The U.S. dollar index fell to around a 3-year low at the beginning of July, bounced back a bit in August. It's been sideways to lower for the last 6 weeks. What do you see ahead for the greenback?
The dollar's been kind of, it's been a bit disappointing for me. It's basically been flat here the last 6 weeks. I mean, it's just boring as hell. I think there's a real indecision here. It's a huge market in terms of the volume of trading that happens around the world. The global FX markets make the stock markets look, like small in terms of dollar value, underlying dollar value of what gets traded. And the market's just treading water here. What do I think? I think one of the things that's always important in the foreign exchange market is the relative interest rates between two different currencies. Let me put it to you this way. If country A has got interest rates at 4% and country B has got interest rates at 8%, all other things being equal, and of course they never are, people will put their money in country B because they'll pick up what they want the yield pick up. Now, you can look around the world and say, well, there's the Swiss franc, and their interest rates are pretty much at zero, and yet it's the strongest currency in the world, so Victor's theory is out the window. Well, that's where I say, if everything else is equal. If you had a situation where country A is at 4% and country B is at 8%, but country B, they got people rioting in the streets or they got this or that happening, you're not going to put your money there. So they can offer you, 15%, and you're still not going to put your money there. And that would be, say, not people rioting in the streets, but a country that has extraordinary high interest rates, and the currency has been going down. A great example of that's been Turkey over the past few years. So, but for the regular market, for the day-to-day grind it out, the fact that the U.S. central bank looks to be entering an extended easing cycle, and other central banks either aren't or are raising. For instance, the ECB, the European Central Bank, has already cut rates. Looks like they're going to kind of stand pat for a while. The Japanese are actually raising, and they will raise rates more. So I think that's having a bearing on the U.S. dollar. In other words, the U.S. dollar would be stronger if it wasn't for that, the expectation of falling interest rates. Now, on a longer-term basis, you've heard me say this many times over the years, capital comes to America for safety and opportunity. If there's another geopolitical flare-up, okay, that's the polite language we use these days for things like when one country invades another. If there's something like that happens, capital will come to America in a heartbeat for safety and bid up the value of the dollar. In terms of opportunity, it looks like, the American stock market represents something like 70 or 72% of the market capitalization of the entire world's stock markets. So there's a reason for that. There's just America, there's all kinds of companies you can put money into. A lot of them are going to be great companies, so that acts as a magnet for capital. You go around the world, the U.S. dollar is a reserve currency. The central banks of the world hold more U.S. dollars in their reserves than certainly any other currency. I should interject here. There's been something happen with gold lately. I've seen some charts pointing out that central banks now have more money invested in gold in their reserves than in U.S. Treasury bonds. I think that's a function of the price of gold's jumped 40% this year. Now, something that often happens with institutional accounts is they rebalance. If they've got a portfolio diversification and something within their portfolio, say, jumps up in price, they may sell some of that to try to get back to the balance they wanted. But whatever. The U.S. dollar, there's always been some pretenders out there, the BRICS or whatever, that they were going to become, the new bloc, and that the U.S. dollar's best days were behind it. That may happen, and I really, sort of at an intuitive level, I feel as though there's a lot of things where we're sitting at kind of a turning point right here, and that's my trading gut feel or something like that. I feel that at a political level for sure, and anyway, we can talk about that more later.
What are your thoughts on the Canadian dollar?
Yeah. I knew you were going to say that. The loony's struggling, okay? What do we got now? Our unemployment rate, and again, this is figuring that Stats Canada can count, but whatever. The last figure was 7.1%. Youth unemployment's running around 15%, and the youth these days, that's sort of everybody between 15 and 24, I think, is the bracket. Carney's talking about going aggressive fiscal spending to do, they're going to up their military spending, ramp up infrastructure, do this and that, so the government wants to spend a lot more money. And that could be supportive or not. And then there's the whole thing with tariffs. I mean, that seems to be quieting down now, but certainly in some sectors like the metals exports, aluminum, steel, I mean, it's been a disaster for those industries. There's talk of, secession. Not Calgary, but Alberta wants to, I believe next year is going to put it to the people. Do you want to separate from Canada? This may be the darkest moment before the light or something for Canada, but Canada clearly struggling. We're down around 70, 72 cents, that sort of thing. I've voting with my feet. I'm more inclined to, and I have the choice to have my accounts in U.S. dollars or Canadian dollars, and they're all in U.S. dollars now.
The leading global stock indices have experienced strong rallies since the April lows, with many now at or near all-time highs. How are you trading these markets?
Okay, I'll come right to that point. It's really hard to buy markets at all-time highs, especially if you're as old as I am. These markets remind me very much of 1989. I know that's 26 years ago, and for some of your listeners, that might be past their horizon. Like they weren't there then. But I remember the venerated the Vancouver Stock Exchange, where Rip Snort Mining Company became ripsnortmining.com. And their share values doubled overnight. And, it just I think the BSE went for the better part of a year, it seemed, without ever having a down day. Now I see the Toronto market, since the April lows, I don't know, I counted them up the other day. It was something like we've had 17 of the last 19 weeks, the prices have been higher, that kind of thing. Equity markets are have been very aggressively bid. I mean, they seem when I say the equity markets, I'm going to focus on the S&P because that is, for me, that's the world's stock market. Anybody anywhere can trade that market. That's got the hugest market cap and all that kind of thing. It seems to be stalling a bit, but man, you can't short it because it's just got so much momentum to the upside. And it's tough to buy it here. Say, well, again, like I mentioned with gold, if you buy it here, how much pain are you willing to take? And there's all kinds of participants in the market, people that are in and out of trades I shouldn't say people, machines that are in and out of trades in a matter of seconds. And then there's, people or pension fund managers or whatever that take positions that they're going to hold for years. I think there has been an incredible run on, what are we up, 35-40% for the S&P and the NASDAQ from the April lows. That puts us up maybe 10 or 12% for the year. If I stand back, and I can do this with all my computer screens here, I stand back and have a look at where call it the stock market, has been over the last 20 years, you go, holy mackerel, this market is in full-on parabolic rally mode. So the contrarian in me loves to sell something like that, but I've been chasing, I've made some money trying to pick the top of the stock market, but I've lost more. So I'm just not doing that anymore. If you're asking me, that's how I'm trading the stock market. It's really tough. In fact, for me, it's impossible to buy the stock market here. I look at the complacency that's in the market. I look at how things are positioned, the sentiment, and I just don't want to be a buyer.
Copper raced to record highs in early July, but then tumbled by around 25% in late July due to tariff news. Could you explain what happened in July, and what do you think copper is going to do now?
Yeah, copper was a victim of what seemed to be hasty declarations from, call it the administration, if not Trump himself, the administration, where there was going to be tariffs put on copper. And the wording of the news release, as it were, was such that people in the world thought that anything copper was going to be subject to 50% or whatever it was, tariffs. like a lump of raw ore or some polished work of art made of copper, whatever. And the share price jumped sharply, and in I think the first week of July, and for a few weeks there was basically two markets for copper. There was the market in the United States, and call it the COMEX, and then there was the market outside of the United States, and the COMEX price was trading a hell of a lot higher than the rest of the world because of trying to price in these tariffs. And I think finally somebody got through to whoever makes these kind of announcements, and they backpedaled. They said, yes, refined copper or products made of copper, not subject to the tariffs. And of course, the rationale is, for crying out loud, we need all the copper we can get. Let's not make it more expensive. We got to, enlarge the grid. We're going to have all of these data centers and so on and so on and so on. There's going to be a huge demand for copper. Well, people that had bought into copper and driven it up to $6 a pound, all-time highs in copper, suddenly had the rug pulled out from under them, and the price fell 25%. And I mean, it fell 25% in a minute. This is the kind of volatility you can have in virtually any market, but it doesn't. It happens, say, more in the commodity markets than elsewhere. And of course, people that are trading copper have the opportunity to be doing that with a hell of a lot of leverage. So obviously, some people got killed because of this, call it administrative error, in not being really clear that not everything copper was going to be subject to the tariffs. Now, there was something similar, while I'm on the roll here, that happened to gold, although that came later than the copper episode, where it looked as though, again, the way it was written, it looked as though gold bars coming from Switzerland into the United States were going to be subject to something in excess of 30% tariffs. And that was just a boo-boo. The administration, it was a few days. I don't think it was even as much as a week later. Oh, no, they're not subject to tariffs. So there's been kind of, sometimes when you have a philosophy that says move fast and break things, you break things that you didn't really mean to break, and then you got to go tidy up. And I think that there's been some of that for sure in all of this business about applying tariffs to different things. What's going to happen in copper in the future? Let's take a couple of thoughts on it. First of all, I think the copper price has come back down to a level that's real. The $6 level was kind of BS or something that was trying to take into account this tariff premium on the regular price. And I think certainly some people must have just, been really hurt when this market fell as sharply as it did, given the leverage that's available in copper. So I'm going to say that the price of copper here, call it around $4.50, is pretty real. I think there's some pretty real support at that level for copper. Once burned, twice shy. Maybe people are going to be a little shy about trying to, bid this market higher. They saw what happened the last time, but I think there will be a real bid in copper, and I can understand and embrace there's a shortage of copper story. So I think copper has probably got a fairly solid bottom under it and could go higher. And let me insert the usual caveat. This is not investment advice. It's just my thinking at the moment.
WTI crude has been trading mostly between $62 and $68 since late June, near the low end of the range for the past 4 years. Can you see WTI trading with a $50 handle?
Yeah, I can. We talked a few minutes ago about how gold is trading at not only nominal all-time highs, but inflation-adjusted all-time highs. Well, if you were to look at crude oil on an inflation-adjusted basis, it's probably dirt cheap at $60. I'm not kidding. Crude oil was trading, in the $30 range, say in the 1980s. Well, if it was inflation-adjusted, it'd probably be I don't know what, 150 now. I'm just grabbing numbers out of the out of the back of my mind here. I think crude at $60 is dirt cheap, but so why? Why is it dirt cheap? And here's the thing about commodities. High prices are the best cure for high prices, and over the centuries, for crying out loud, technology of the day has pressured commodity prices lower. And I think, I go to these regular annual conferences that Joseph Schachter has over in Calgary, and I'm blown away, and I'm so proud, honestly, of the technological advances that have been made in the oil patch, and that includes natural gas, of course. These guys, it's just amazing how much more hydrocarbons they have found around the world. They have been able to access those, they have the technology to access those, and then they can transport that stuff to other places to get it refined and whatnot. The technology has just really crushed the price of crude oil. There's that. And then, more day to day, I mean, we've seen OPEC here the last few months have been ramping up their production, or at least ramping up their, what do they call it, their allocations. You're allowed to pump so much, and you're allowed to pump so much, and so on. But, there has been an increase in supply from the known producers, and we're also finding, more, and there's more coming on stream that's not OPEC, or OPEC plus constrained. So, there's been this supply side increase. I keep talking about supply and demand in crude. I mean, that's the nuts and bolts of the crude market. Certainly there's going to be some wobbles one way or the other about crude oil coming out of Russia and finding a home someplace else. Whether, I think everybody knows about shadow fleets and all of that kind of thing. India is basically saying, thumbing their nose at the Americans for getting lectured that they should stop buying Russian crude. China clearly doesn't give a damn. They're building a whole new pipeline. I think, the pipeline's a natural gas pipeline, but this thing of trying to have sanctions to punish somebody and have put sanctions on crude oil, I mean, in my lifetime, I've never seen it work, because crude is fungible and it moves. And it's needed, and there's demand for it, and people will be there to facilitate that. So you've got to find a different way if you want to try to punish Russia than trying to sanction crude. Anyway, I think there's also been been less increase in demand than might have been anticipated. Certainly we're seeing in the futures market that the bullish positioning, in other words, the number or the volume of speculators that are buying crude, is at I'm going to say it's at a multi-year low. Speculators are just, I don't see much upside in this. I'd rather go trade something else, or I don't want to be a buyer of crude here. So I think it's under pressure. Could we see higher prices in the future? I think, sure, for a couple of reasons. One is we get another geopolitical scare of some kind, where that causes the market to freak out about the availability of free supply. And, maybe we just, at some point, the emerging markets of the world who look at the West and say, I want to live like those guys. I want to have air conditioning. I want to have this and that. Will raise the demand for crude. I know my good friend Joseph Schachter sees crude oil sometime over the next couple of years reaching all-time highs. What was that? $147 in July of 07 and 08. Pardon me. Yeah, so I could see that, but certainly right now, in the here and now, crude oil's been under pressure, and I could see us trading below $60 for sure.
You've been actively trading macro financial markets for 50 years. Obviously, a lot of things have changed, but is there anything that has stayed the same in terms of how you make trading decisions?
Okay, this is like at a very organic level. Yes. As much as I said earlier about machines that are buying and selling stuff within a matter of minutes, moments. I mean, I can see it on my screens. I mean, I trade some very, very active markets, and I'm watching what we call the depth of markets, the ramp of bids and offers in there, and I can just see those things just changing so fast, and it's machines. So we didn't used to have that, and now we do, and that certainly changed the nature of the market. But the classic thing to me that has stayed the same, and it'll always be there, is let's call it fear and greed. People buy stuff because they think it's going up. If it's going up, they want to buy more because it's what's they call it, FOMO, the fear of missing out, and the fear and greed are great motivators, and the machines can do all they want. But at the end of the day, let me give you this idea. From where we stand right now, I think there is no fear in the market. And virtually no fear priced in the market. There's things to worry about in the world. I get that for sure. I'm not ignorant. But in terms of how the market's priced, the market is not afraid of anything right now. Volatility is really low. Nobody's interested in buying a put, okay? If you're going to buy anything, you're buying calls. And people are buying calls that expire this afternoon. And to me, that's just a sign of this market has become very bold, perhaps, and when you get rewarded for being bold, you get bolder. It's just the way it works. There was a market wizard in I think maybe the first market wizards books that came out back in the 1980s, before they invented color television. Bruce Kovner said something to the effect, he said, I'm looking for a consensus that the market is not confirming. I like to know that there's going to be a lot of people who are going to be wrong if I take this position. So what that kind of means is, I'm always looking at sentiment and positioning. And when you have something happen in the market and you say, geez, it amazes me. That thing happened and the market didn't react. Well, that's because the market had anticipated that thing. It was already priced in. So, when something happens that the market's not expecting, that's when you get some dynamite price action. And I love those kind of things if I'm on the right side of them, okay? So right now, as I say, volatility is very low. There's no fear in the market. People have practically no fear. The market, there's so much capital that's in the market now. It's called passive. People just every month put some money with their money manager guy, whoever he is, and that money just goes into the market and it's distributed amongst the different stocks in the market based on the weighting of those stocks. And the story is, listen, don't try to time the market. Don't try to pick individual stocks. Just buy the whole market. Okay, Bucky, put your money in there, and, you put a little money in on regular intervals, and by the time you get to be old, you're going to be rich. That's it. And look, let me show you the chart. This is what's happened in the last 40 years. This is a lock. You can't lose. Now, I'm being sarcastic to exaggerate my point, but I believe that people and their emotions are still and will ever be a primary mover of the market. Now, can I judge the timing of when this happens? Well, you do your best you can. I'm saying I can't buy the stock market here at all-time highs. That's making a judgment. I can very easily, press a button and I'm in. And I'm not doing that. I just feel as though I don't want to be a buyer here. At the same time, I don't want to be a seller, but I'm looking. Believe me, I'm looking to be a seller, and I know there's a lot of guys like me out there that are doing that same thing. And if this thing, like happened in April, man, that crack we had in April was a beauty. And then when the market started to come roaring back from the lows, I was a buyer. That was a beauty. But, when a market's just sitting quietly at all-time highs, I just gotta learn to just sit on my hands and watch it. So the thing that's the same, Jimmy, sorry for going on, but it's people. It's people making decisions, and their decisions are going to be driven by emotions, and that's when it gets really interesting as a trader.
Victor, thank you so much for being on This Week in Money.
Jim, it's always fun talking with you. Thank you for having me on.
My guest has been Victor Adair. Check out his website, VictorAdair.ca. He was speaking to us from Parksville on Vancouver Island. Coming up, Hilliard MacBeth, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Hilliard MacBeth, author of the second edition of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. His website, MacBeth.McLeodPartners.com. You can find him on X at HMacBe. Hilliard, the second edition of your book, When the Bubble Burst, is on sale now. Are we starting to see the bursting of the bubble, and would now be a great time to read When the Bubble Bursts?
Yes, I think we are seeing the bubble bursting. It's been a slow burst, but the stuff that I write about in the second edition of the book is all happening now, and or most of it anyway. And so it makes great reading at this time. People can purchase it on the ebook, like Kindle and the other ones, Kobo and that, and also in bookstores across Canada.
In your book, When the Bubble Bursts, what are the first signs a bubble is starting to blow up?
Well, you know, the homeowner that's seeing a drop in the value of his house or his apartment is reluctant to cut the price, right? So what happens is you get this long period at the beginning of the bursting of a bubble where there's a bunch of sellers, but the buyers are more pessimistic than the sellers. They want to bid low. So basically what you get is just a lack of activity. There's no sales because the buyers are too high, or the buyers are too low on their bids and the sellers are too high on their price. And we've been in that now for a couple of years. It's a very long period. And the activity levels are at record lows, even compared to the early 1990s when there were way fewer people in Canada and way fewer homes in Canada. We're starting to see those kind of levels of activity, which are basically almost no activity. And as I say, the trigger is usually the lender. So there's a lot of debt involved in real estate, as we know, especially with the prices being so high. And there's a lender that's watching. And now they don't watch that closely when the market's rising, but they start to watch more closely when the market's falling. And they may decide to protect the remainder of the value of their property because it becomes their property. At some point, they want to sell quickly. And they take over the sales process from the seller who's got the price listed too high, and they take over the process and force the sale at a much lower price. So we're somewhere in between zero activity and the start of the foreclosure activity. It started to pick up, but it's from very, very low levels. So foreclosure activity was extremely low when prices were rising steadily because you didn't never need to go through that process. But now people are starting to get into that. So we're still in the early stages of the bursting of the bubble.
What's the latest on Canadian home sales, inventory, and pricing, especially in the Greater Toronto Area, Metro Vancouver, and other major cities?
So the problem in the Toronto area especially, but it's also true in Vancouver, is that there's just so many properties on the market for condominiums, and they're just not selling. So people have, there's a bunch of different aspects to this. There's investors who have bought condos several years ago, renting them out and losing money every month and starting to panic because for a long time they were willing to lose a couple $100 a month because they thought the condo price was rising. And now the writing's on the wall. It's very clear that with all of the new apartments coming on stream in the next couple of years, and the prices are starting to be cut by the developers who are selling new product, there's zero chance of those people trying to flip their condos they bought several years ago for a profit. So now they're looking at taking a loss, and they might as well cut their losses now rather than wait and lose another $200, $300, $400 a month as the time goes. There's also a problem with just finding renters at this point for investors. So that's an aspect of it that has just got a tremendous number of listings on both for single family, but especially for condominiums in Toronto. And it's starting to happen in Vancouver as well. Some of the Vancouver developers are starting to get into trouble. A couple of them have declared receivership or bankruptcy. There's more to come on that front, and several of the new projects are being canceled. So it's becoming pretty clear that this is going to be the crunch time. There's a lot of listings in Toronto and Vancouver, but now even in Edmonton, Edmonton was in Calgary were considered the best places in Canada because people were moving there, and there's quite a bit of activity. Prices were still rising up until a few months ago, but now they're starting to take over. The unemployment rate in Edmonton is at close to 9%, which is one of the highest in Canada, probably because of all the people that moved here. And the real estate market started to show some serious cracks in Edmonton and Calgary as well. So even the hottest market in Canada, Calgary, is starting to roll over into a I wouldn't say a bursting of a bubble, but a very, very soft market. And it'll just get worse from here.
Do you think a number of factors could combine to cause a perfect storm housing crash?
I think they are already. I think the biggest factor, I've got a weekly note I put out. People are welcome to find it on Twitter or on X, formerly known as Twitter, on HMACBE. Is my handle, or you could find it by going to the website, MacBeth McLeod Partners. And the story this week is from economist Steve Keen, who wrote a blurb for my second edition of my book. And one of the most renowned economists in the world, because he correctly predicted the 2009 crash. And what he talks about in a recent video, which I cover in my note that's coming out on Friday today, is the fact that mortgage lending is the fuel that drives housing bubbles. And if it's not just mortgage lending increasing at a steady rate, but it's actually acceleration in mortgage lending. So you need to have an additional credit impulse each year compared to last year to keep the housing bubble going. And we're starting to get a deceleration in mortgage credit, which is fatal for housing markets because, as you can imagine, each year there's more debt piling up just from the interest on the debt that's already been issued. And people need to be able to borrow more money each year as house prices rises. So if mortgage lending shrinks, to simplify his analysis quite a bit, then the housing prices have to come down, and also probably the economy has to slow down too. The other thing that's happening in Canada, which is he doesn't talk about, is the fact that interest rates are going to be rising for the average borrower. So interest rates have been pretty stable for around 5%, somewhere in that range for a couple of years, but a lot of people had 2% mortgages from 3-4 years ago. Now those mortgages are coming up for renewal this year and next year, especially. Seen some very high numbers, like 60% of all mortgages will renew in the next 24 months. And invariably, almost all of those will be at much higher interest rates. So that means the household will have less money to spend elsewhere if they decide to renew at the higher rate. They don't really have much choice. And what they also might do, though, is they might decide to sell some other assets or delay some purchases in order to pay down the mortgage because they need to get that amount of debt to shrink. So this is the perfect storm for a housing crash. Lack of new mortgage lending and the refinancing of old mortgage borrowing. About 75% of all household debt in Canada is mortgages, and Canada has one of the highest, if not the highest, household debt ratios in the world. And so we're looking at a perfect storm housing crash right now.
What's the latest on unemployment numbers in Canada and the U.S., and how accurate do you think those numbers are?
Well, of course they're not accurate. They basically ask people, do you have a job, and are you looking for a job? Well, a lot of people just say, no, I don't have a job, but I'm not really looking that hard. And of course, the stories out there now are that people are putting out 200 applications, 300 applications, and they're getting no callbacks. So they get discouraged, and that's what they call it. They call it discouraged worker But they're not included in the unemployment numbers necessarily, because as long as they're somehow looking for a job, they're considered to be not unemployed. I guess they're considered to be between jobs. So the actual numbers are in the U.S. numbers are still fairly low. They're at 4.3. That uptick from last month from 4.2% to 4.3%. But the interesting thing about that is it's about the bottom was around 3.5, so it's gone up about 0.8%, which in the past, there's an economist called Claudia Sam, and she created the SAM rule, which says anytime the mortgage rate upticks by about half a point over a 12-month period, there's always a recession. Now, she's backed away from that a little bit, but we are now ticked up well more than half a point. And I think it's an indication of a U.S. recession. In Canada, the numbers are much, much higher. As I mentioned, in Edmonton, it's getting close to 9%, and across Canada, it's somewhere around 7 or 8%. So these numbers are typically what you would see in a recession. And of course, again, they're not including a whole bunch of people that are maybe signed up for a community college course because that was part of their visa application under the temporary residency coming from another country. So there's a whole bunch of people that are not counted in there. If you counted all of the people, and there are a number of people on the line you can find if you do a search that'll have unemployment numbers in the 20% range when you include all of the people who don't have a job. But that isn't the way they report it. But even on the basis of the way they've reported it in the past, it still is getting very close to recessionary type numbers.
The Bank of Canada meets on September 17th. What do you think they'll do?
Well, I think they'll cut rates, and I don't necessarily think that they should, in the sense that even though we've talked just now about a housing crash and we've talked about unemployment numbers, the stock market just hit a record high, and house prices have not come down that much yet. So compared to the 1980s, interest rates are still very, very loose. There's not a tight monetary policy out there yet. So, but the Bank of Canada will cut rates. I'm sure they'll cut them a quarter point. They'll point to a softening in some of the forward-looking economic indicators. But it doesn't really make much difference. The thing about cutting rates is that it only works with a lag in order to try and stimulate the economy. And it primarily works through the housing market. So in the past 50, 60, 70 years, every time the central banks in Canada, the US, England, wherever, have cut rates, it's stimulated a boost in mortgage borrowing, which has boosted the housing sector, which is spread into the wider general economy. So now we're not in any position to do that now in Canada because we've got this housing situation that we just talked about. So cutting the rates by a quarter point, it might not even move the mortgage rates at all. And even if it did move them a quarter point, it's not going to create a whole bunch of new borrowing, because the problem is not just with the mortgage lending, but it's also with the collateral, the price of the house. The prices of housing are too high, and therefore the buyer cannot qualify, and so you can't fix that with a lower interest rate. You could maybe fix it with a much lower interest rate, which is what they did back in 2020 and 2021, where they put the rates down close to 1%. Then everybody could qualify for a mortgage, even if house prices were $1 million. But hopefully they won't make that mistake again.
The Fed's meeting at the same time the Canadian Bank is, September 16th and 17th. What do you think the Fed's likely to do with rates, and do you think the Fed could decide to stop printing money due to their conflict with President Trump?
Well, just to talk about the U.S., we talked about Canada. So the U.S. will probably cut rates as well. They've got a mixed bag of indicators. They can point to strength in the economy with a huge boom in the stock market, for example. Housing prices have been coming down, but they don't really have a crash on their hands like we do in Canada. Unemployment rate is still relatively low at 4.3%, although it has been rising. There's no real reason to cut rates, but they probably will cut rates. The one thing that might stop them, though, is President Trump's been asking them to cut rates or or bullying them into or badgering them into cutting rates. So they might get defiant and say, no, we're not cutting rates because we don't want to look like we're caving into demands from politicians, which is the big independence of the central bank argument. And so Trump's frequent hectoring of the people at the Federal Reserve, especially Jay Powell, he calls him too late Powell, might backfire for Trump in the sense that there might be a stalling whereas there normally would be a rate cut. Real estate developers always think rates are too high. It's just normal, and Trump is just acting as a real estate developer, even though he's president of the United States and not thinking about much else. But again, in the U.S., it won't make much difference either. The crash that's likely to come in the U.S. is more in the AI stock market boom rather than in the housing boom. And cutting rates wouldn't make much difference into that, or not cutting them. I think what's happening now is bigger than just the odd quarter or even half a point in the bank. And by the way, as we talked about in the past, Jim, the Bank of Canada and the U.S. Federal Reserve, they don't control the interest rate. They control the Fed funds rate in U.S. and the Bank of Canada rate in Canada, but that's not the actual interest rate people pay. People pay the mortgage rate based on other factors. People pay the margin loan rate for their stock market investments based on the prime rate that the bank set. And the prime rate the bank set doesn't necessarily mean that it doesn't necessarily follow the central bank rate. So people have got a distorted view of the importance of the central banks. They're not as important as we all think.
Is the success of stock markets dependent on money printing and possibly money laundering?
You know, the success of the stock markets is not as connected to money printing and money laundering as the housing market is in Canada. Money laundering in Canada has been a huge factor in this housing bubble, along with excessive mortgage lending, because it's a psychology thing. If some guy comes in from Hong Kong, let's say, with $20 million and buys 4 houses in West Van, I don't know, does that get you? Maybe that doesn't even get you 4 houses in West Van, 3 houses in West Van. Then and he doesn't care what price he pays because he's got $10 million he has to launder, right? So he just pays whatever is asked. It doesn't care, and it sets the bar for all. And so all of the other people are thinking, "Oh my God, the prices are so high." But you know, that guy paid $3.5 million for that house, so I guess it's okay for me to pay $2 million. So it sets a tone. But in the stock market, it doesn't really work that way. The stock market is based on a lot of other factors. One of the biggest factors in the stock market is momentum. So in the since April the 2nd, Freedom Day, Trump Tariff Day, the stock market is up something like 30% in the U.S., and a lot of it's being driven by the AI boom. So the AI boom, call it the AI bubble if you want, is way more important than money laundering or money printing.
The Dow, the S&P 500, NASDAQ, and the Russell 3000 have all been hitting new all-time highs. Can this bull market continue? It
can continue for sure, but at some point it'll have to correct. And this is very much like 1999, 2000. But there was a time in 1998 when the then Fed chair, Alan Greenspan, talked about irrational exuberance. So even in 1998, more than 2 years before the peak, he was talking about the stock market had gone too far. You know, we're obviously seeing irrational exuberance today, but can it go a lot further? Of course it can, but at some point it will. And this one has gone so far now that it's likely to be a 2002 type correction, which in the stock market was 50%. But in the high-flying internet stocks in 1990 and 2000, it was more like 70 or 80%. Amazon, which was one of the early internet stocks in 1999, 2000, went down from $60-something down to $6, over 90% drop. So it's the NASDAQ as a whole in 2002 went down 80%. So for sure they could correct. And this week, for example, Oracle signed a deal with OpenAI, where OpenAI was going to buy $300 billion worth of data center product from Oracle and Oracle stock went up something like 30% in one day. And Larry Ellison, who's a CEO and major shareholder of Oracle, became the richest man in the world. He passed Elon Musk. The problem with that story is that it's over 5 years. First of all, $300 billion. Secondly, OpenAI doesn't have even $100 billion, never mind $300 billion to spend on data center product. And it's not even clear if Oracle could actually supply that amount of product. So it was totally, it was announced the same day as the earnings results Oracle released, which actually weren't that great. And it managed to excite the stock market by quite a bit. So we're at that stage, the silly stage of the stock market bubble, if you like. And yes, they can hit new highs, but it's based on pretty frothy, and it's not based on fundamentals anymore. It's based on extreme momentum.
The TSX Composite Index has hit new all-time highs. Can this bull market continue?
So the TSX Composite is different in that it's heavily weighted towards financials, especially the big banks, and also mining stocks and resource stocks like the oil and gas companies. There aren't very many NVIDIAs and OpenAIs and Oracles and Microsofts and Teslas in Canada. In fact, there's only one company probably that could be close to that would be would be the Shopify, which is kind of a mini Amazon type situation. But so if you look at the major components, the biggest one, of course, is the banks, the financial sector. They're going to be hit really hard if the housing bubble bursting phenomenon gets any worse at all. In fact, it doesn't even need to get any worse. It's already going to hit them pretty hard just with the current flat mortgage lending for the last 2 or 3 years and a decline in house prices of about 10 to 20% nationwide. So it just hasn't shown up yet in their numbers because they have a lot of ways to defer and delay and work with the lender who's defaulting or the borrower who's defaulting to delay recognizing the fact that some of their loans are going bad. So it's going to be very difficult for the TSX Composite to continue. It doesn't have the momentum that the U.S. market has because it doesn't have the AI stocks, and it's got a serious problem at the heart of it. The one bright spot in Canada, and it's very bright spot, is the commodity sector, especially not the oil and gas so much, but the copper, nickel mining, gold mining, that sort of thing. Gold is hitting new all-time highs, and that's likely to continue because it's at a very early stage, unlike the U.S. stock market. And so that'll help. There's an awful lot of companies in Canada that have what would be marginal mines at prices from 2 or 3 years ago, but are now becoming very profitable mines at today's prices. So, the Canadian stock market is a different animal, but the headwind is going to be that financial sector.
The TSX Venture is at the highest it's been since the mid-2022. Are you bullish on the junior stocks, especially the junior miners?
Yes, well, we're going to talk about gold now. So gold is the key factor. So I probably told this story before, but in 1980 or 81, I forget exactly the date. I think it was 80. Gold hit $850 an ounce, and I think it was in February. And they come to the stockbroker's office, and in those days we all sat in a bullpen, and they said, "Can we talk to somebody about gold?" So of course I ended up doing it. Everybody else was hiding under their desk. And the TV came in, the TV cameras, and they said, "What do you think about gold?" And at that point, people were taking their anything gold jewelry, anything, and cashing it in to try and get the money because gold at $850 an ounce was very attractive for them to sell their stuff. And anyway, I forget what I said exactly, but I'm sure I said something like it's like I just said about the housing market. It's a bubble waiting to burst, and all kinds of people came up to me afterwards and said, "I saw you interview on gold, and isn't gold great?" And I said, "Well, that's not exactly what I said." But anyway, so at any rate, gold after that turned out to be, the day of that interview turned out to be very close to the day of the peak, and not my doing, but that's just the way things work sometimes. And gold after that went down to $300 or something and stayed down forever. And is now back to $3,650. Well, it turns out that if you take the inflation-adjusted $850 price in 1980 and convert it to today's dollars, gold is now above, it works out to about $3,300, $3,400 an ounce. So gold is now about 10% higher than that peak back then. And I think it's going to continue. I haven't seen interviews like the one I did in back then, asking people, you think gold's a great investment and all that sort of stuff. It's early days. So people are still trading AI stocks. They don't even know about the gold situation. So it starts with Newmont. Now, Newmont was one of the best performers in the S&P 500 in the last 3 or 4 months. It performed extremely well, and it's coming off a very, very long period of just flat. But I mentioned Newmont because it's the only gold stock in the S&P 500. So there's only one stock in 500 stocks that is related to gold, and it's a pretty big company, as is Barrick and Agnico Eagle, and those are the three. So the three big ones, and then there's the mid-sized ones, and then there's the juniors. So the juniors trade on the TSX Venture, which used to be the Vancouver Stock Exchange, and they perennial. They don't have any money, so they just scrounge and try and find money and whatever, do a little work on their project. They've often got a lease or something, and they're doing some exploration, doing some drilling, whatever, if they can find the money to pay for the driller. And then the price goes up, and then all of a sudden now they're starting to get some interest. So because they've been so broke for so long, when this gold price goes up like this and the stock market starts to rise, one of the very first things the juniors do is they sell a whole bunch of new stock into the stock market to get money, because they need money. They have to pay down their mortgage on their house. The promoters do. So this is the problem with the juniors. The upside is there's going to be a junior that has sitting on a property that some big major like Newmont or Barrick or Agnico Eagle comes in and takes a position in that junior and develops it into a mine. But the problem is we don't know which one. And the rest of them are probably going to have a real nice little run here, and then they probably will disappear into obscurity. So I wish I could tell which ones is the one that's going to be the one that, actually there'll probably be several of them, because there haven't been any new mines developed for the longest time. So the majors are hungry to find a new mine. So you can watch what the majors do. You can watch which juniors get attention from the majors, or you could buy probably the best way to do it is to buy a dozen or 2 dozen of them and hope that one of those hits a go. Because the one that hits it big, you're talking about 100-fold increase or something like that, right? So you can make up for a lot of them that go to zero if you buy enough of them and do a spread, and hope that one of your, it's like buying 10 lottery tickets instead of just one lottery ticket. But it definitely is in the category of buying lottery tickets when you're talking the junior mining companies.
What do you think's fueling gold's new highs?
Well, the problem that we have with this whole thing with the central bank and Donald Trump and Jay Powell and all that sort of stuff is the central bank is supposed to preserve the purchasing power of the U.S. dollar and the Canadian dollar and the British pound and all that, but they don't. What they do, in the U.S., they have a second mandate, which is called promoting maximum employment. And so whenever there's a slowdown in the market or in the economy or in the stock market or in whatever, there's a crisis of some sort, the central bank steps in and does silly, stupid things. And 1987 was an example when the stock market dropped 20% one day. There's no reason for the Federal Reserve to get involved in that, but they did. 2000, the stock market bubble burst with the internet stocks. The central bank steps in. 2009, the central bank steps in when all the banks got crazy with subprime mortgages. 2020, COVID comes along, the central bank steps in again. None of that goes towards preserving the purchasing power of the currency. So what's happening with gold is that people are realizing that there's not all these people who should be protecting us from runaway inflation are not doing their job, and they never really have. They've sort of pretended to pay lip service to, well, we got to keep inflation under control, but they didn't in the surge of inflation that happened after 2020. Now they're already they're on the verge next week of abandoning their inflation target, which is 2%, when inflation is actually rising right now, and it's almost 3% right now. So they didn't even get close to 2%, and they certainly didn't keep their foot on the brake for very long. So there's so much pressure on them. So it's not that easy to protect yourself against inflation. Real estate in Canada is not a good protection against inflation because it's the housing bubble's bursting. So what do you do? I mean, you've got very limited options. There's gold, and there's another thing that you can do, which is the inflation protected securities. The government of Canada and the government of the United States have issued bonds that pay you whatever the inflation rate is in interest. So that's pretty cool. But beyond that, there just aren't that many options. So that's why gold is getting renewed attention. Plus, the other thing is central banks all over the world are buying more gold, and they're a big factor in the gold price. So when central banks are buying gold, maybe that's trying to tell us that maybe it's they think it might be a good thing to hold some gold.
Silver's been hitting new highs. Where do you think silver could go from here?
Well, silver I put in the category of the Vancouver Stock Exchange juniors. It's sort of the poor man's gold. So gold goes to 3,600 from say 1,200. So gold has tripled, and the speculators look in and say, "Oh, gold. I missed gold, but I can get in on silver because silver's still cheap." So that's part of the way it goes. The other thing about silver is it's got the primary factor in gold is the people's willingness to hold it as an investment or a speculation. It's the actual annual consumption of gold for jewelry, for example, is not that big a factor. It's basically with central bank buying plus investment speculative buying of gold. But in the case of silver, it's a little different because they actually use quite a bit of silver in things like solar panels, for example, or electronics, that sort of thing. So you could make an argument there, but it's generally going to be more of a speculative thing. I would prefer gold over silver if you're going to speculate, but silver will probably go along with gold. If gold keeps going higher, silver will too.
Do you think President Trump's tariffs could make the U.S. a manufacturing powerhouse?
I don't think so. No, absolutely. I would almost say absolutely not. I saw an interview with a guy that was a small businessman in the U.S. and he had been sourcing his products manufactured in China and then selling them in a very successful business. Most of his sales were online, I think, as I recall. And he said, I went to every corner of the United States trying to find somebody that could do what the people in China do for me. And he said, they can't do it. The people do not exist. There's no people that know how to do what the Chinese can do. And even if they did exist, it would be double or triple what the cost is that I'm paying in China. So it's not going to happen in the U.S. the way the U.S. is currently set up. And the Chinese have such a lead now. I mean, it used to be the Chinese made cheap stuff, but they didn't make good stuff. Now they make good stuff and cheap stuff. So that's going to be very difficult for the U.S. to do. Maybe the answer to the question you just asked is not in the short term, but it is possible in the long term. But I don't even know if it'll happen in the long term. It's almost as if the U.S. is too rich a country to go through the pain of learning how to be manufacturers again. I remember Elon Musk saying about Tesla. He said the most difficult thing is manufacturing. He said that the electric car was a relatively simple design, the battery and all that kind of stuff, but the pain of actually doing an assembly in a manufacturing plant is the most difficult thing. And he's one of the only people, or his company is one of the only companies in the U.S. that's actually been able to do that recently. Whereas literally thousands of companies in China that are working on that, and they're getting better and better at it too. So, and I wouldn't rule them out as passing the U.S. in AI as well. It's like as somebody said, the Chinese are most of the AI companies in the U.S. are employ a lot of Chinese people that are AI people, and the question is, are the better AI people from China in China, or are they in the U.S.? And some people think that the best AI people are in China, not in the U.S. So, no, the U.S. is going to go through a tough time. There's no question. The tariffs are not going to solve their problems.
President Trump and his Health Secretary Kennedy seem to be laser focused on Big Pharma. Would you be buying Big Pharma stocks right now?
Well, we own a couple, and we just bought another one. And when I say we, I'm not a portfolio manager anymore, but I still have an interest in what my former team is doing. And you mentioned earlier that the Russell 3000 hit new highs, and the market generally is very, very bubbly, and the prices are very frothy. But Big Pharma, because perhaps of the risk of a crackdown by Trump and Kennedy, is quite cheap. And yet I don't think that they're going to crack down on pharma as much as the market seems to think. So the prices have come down a lot. There's some interesting companies in there that are worth looking at. So yes, I would be looking at them, and we did buy another one recently. So, but you got to be careful. I mean, it's a hard market, and but yeah, no, the advances in. I mean, Kennedy's very anti-vaccine, but really, the pandemics, the epidemics, the pandemics are going to keep coming. There's always another one coming, and if they have new technology, new vaccines that can fight those infections, pharma's can do very well.
Can you list anything good that Prime Minister Mark Carney has done for Canada?
Well, it's sort of too soon to tell, but yesterday he had an announcement of 5 new projects that are going to be fast-tracked to completion. None of them are in Alberta, where I live, but they all seem like reasonable projects. That's a change from where we were at before. It remains to be seen whether his attempts to manage Trump's personality have worked or not. He says they're talking, and they're having some good conversations. One thing that people don't realize with all of Trump's announcements about this tariff on Canada, that tariff on Canada, and fentanyl and all that is something like 95% of all the products are moving between Canada and the U.S. tariff-free. So a lot of it is just publicity. It's not real, and so there have been some sort of undercurrents of good things happening, but we still have a huge problem with the U.S. I don't think Mark Carney is going to make that much difference. I think the problem is the U.S. Is probably going to buy less from us in the future. There's 2 big exports: cars and car parts. We call that one export, and oil and gas is the other one. The oil and gas is still booming. It's 4.2 million barrels a day. It's the highest it's ever been. There's increasing amounts going to the U.S. Not sure how much longer that's going to last if you think of a decade or 2 decades, because the U.S. is the biggest producer of oil in the world, and now is a big exporter of oil as well. So they probably don't need our oil as much as they did 10 years ago. But in cars and car parts, I think we're in trouble because a couple of the new plants that were mentioned in Ontario that were going to produce EVs have now been canceled or deferred, and the legacy plants that are producing the old technology cars are probably going to be phased out, and they're going to obviously keep the plants in the U.S. going longer than they'll keep the plants in Canada going. So we need to find a new gig in Canada. The one bright spot on the horizon, as I mentioned, is minerals and metals that will be needed for the transition to a more electrified economy. but I don't know that Mark Carney's going to make a huge difference in that. I do like his style, though. When he had his press conference yesterday in Edmonton, he said that the biggest problem in Canada was Connor McDavid hasn't signed his contract yet. So I thought it was funny.
For our non-hockey fan viewers or listeners, Connor McDavid, probably the best hockey player in the world, who plays for Edmonton Oilers, but may play someplace else if he doesn't sign.
Yeah, I didn't. I didn't realize this, Jim. You probably knew this, but I didn't realize that he's only got 1 year left on his contract. And if he's actually not wanting to stay in Edmonton, they have to trade him now, because if he runs out of his contract, he's a free agent, and Edmonton Oilers don't get anything for having the best player in the world on their roster, right? So if they run it out to the end of the year and his contract expires, then he's a free agent to go wherever he wants. And there'll be a lineup of teams willing to pay whatever he asks, within the salary cap rules. And the Edmonton Oilers will just be in that list of people trying to compete for his attention. So they need to do something now.
How close is Canada to bankruptcy?
Well, Canada can't go bankrupt as long as Canada's currency is attractive to the world. So you got your example of Venezuela, and in the past Argentina, countries like that where they could not borrow money in their own currency, right? So the Argentinian peso was just not attractive to anybody because they defaulted in the IMF several times. Canada's never defaulted in the IMF. Canada's one of the very few countries in the world that still has a AAA credit rating. Germany being the other one. Not very many others. Even the U.S. doesn't have a AAA credit rating anymore. So Canada's not even remotely close to bankruptcy. However, as we just talked about, Canada has a lot of problems, and the Canadian government still has the option to spend more money than it brings in through taxation and borrow money in the Canadian dollar, which is fine. But 10 years, 20 years from now, that may not be the case. But at the moment, nowhere near bankruptcy. And this, AAA credit rating is fine.
What's the latest on the push for Alberta independence?
Well, it's really just a few people that are pushing it. I think at some of the Calgary people, at one time Calgary had the population of Calgary was 30% American, based on the American oil industry coming into Calgary and to help us develop our resources in Alberta. And there's a pretty strong dissatisfaction in Alberta with the federal government, as there was in the early 80s when Pierre Trudeau was the prime minister. And Alberta premiers, even Lougheed, going back to Lougheed and Getty and all the Ralph Klein. I think Ralph Klein was the Calgary mayor when he made the famous comment, "Let the Eastern bastards freeze in the dark," or something like that. So it's a long tradition of Albertans, defying central Canada, and yet, but when the crunch comes, what would be the upside? There's no real upside. We're getting a pipeline through BC is going to be harder for an independent country than it is if we're part of Canada. Dealing with the U.S. is going to be harder unless we join the U.S. as the 51st state, as Alberta. I'm sure they probably would love to have us. But other than that, separating from Canada would be pretty much all negative and not positive. So I think in the end, if they ever, the premier's talked about a referendum, but she's had trouble figuring out how to do it. So talked about trying to get an Alberta pension plan away from Canada pension. People don't even want to do that. Most people, the majority of the people, are afraid of Alberta running the pension plan. They want Canada to keep running the pension plan. So it's not very close.
Lucid versus Tesla. Have you driven a Lucid EV?
No, I never have. I've seen one. There's actually one parked close to our house. I walk the dog and I see it there. It looks beautiful. There are a couple of things with Lucid. It's their premium flagship car is $350,000 Canadian, and then I guess their comparable one to the top Tesla is about $150,000 Canadian before the luxury tax. which is similar to the Model S, the one that I have. The charging problem, this is a problem. Tesla's got superchargers everywhere. Lucid, I'm not quite sure how it works, whether Tesla's allowing Lucids to charge. I don't think they are. But the car on the surface looks actually like it's got some pretty good specs, good performance, good luxury handling, all that kind of stuff. But one of the other issues with Lucid is it's majority owned by the Saudi Arabian wealth fund. So I haven't really, when I think about what I would get if I didn't have a Tesla, I looked at Lucid, but I decided, no, that it's better to stick with Tesla for now. The more interesting offerings are actually coming out of China, but we can't buy them in Canada because of the tariffs. So I'd probably buy one of the new offerings out of China. They're very impressive, at least on the features as you read them on the sheet. I have never seen one close up, but people that I respect a lot on X are messaging that the new offerings are spectacularly good. And actually, I have one piece of evidence. My wife got a new Model 3 in 2024, and it was made in Tesla plant in Shanghai, and it is just an awesome car. Like the ride is beautiful. It's super quiet, way quieter than my Tesla. And so whatever they're doing over there, they're obviously figuring something out. And that was probably where the better offerings will come from in the future. But we can't do anything about it now. The purchase that we made in 2024 of the Model 3 from Shanghai plant of Tesla was made before the 100% tariff was introduced. It was like just a month before, so we just slid ahead of the deadline. Now you couldn't possibly buy a Tesla in Canada without paying the 100% tariff.
Where can people follow you, and where can they buy your book?
So they can follow me on X, formerly Twitter, as you mentioned, HMACBE, and I put out a weekend note every Friday, which you can find on X at that address, and you can direct message me if you have any questions on X, and you can buy the book at all the best bookstores and on Amazon, Kindle, and Kobo, and all those places.
Hilliard, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Victor Adair, and Hilliard MacBeth. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.